I'm Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. Do you know how long you can expect your retirement savings to last? Well, I'm about to tell you using something called the 4% rule. But before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. Saving for retirement is relatively straightforward. You spend less than you make and invest the excess wisely. But once you retire, you and your investing enter a very different stage. You go from accumulating assets to decumulating assets. In other words, you start having to withdraw money from your accounts to fund your retirement. The logical question in this case is, how long is my money going to last? Or to look at it from another way, how much money can I take out of my account each year without it running out? Thankfully, there's a pretty good rule of thumb that answers that last question. It's called the 4% rule. In 1994, a financial advisor named William Bengen looked at historical stock and bond market returns from the prior 75 years and figured out what level of withdrawals would have historically been safe such that the withdrawals could have lasted for at least 30 years before the portfolio ran out. Bengen's research culminated in the 4% rule, which says how much money a person could safely withdraw from his or her portfolio each year with only negligible risk of the portfolio depleting in retirement. Specifically, the 4% rule says in the first year of withdrawals, a person could take out 4% of their savings, and then each year thereafter, they can increase the withdrawal by the amount of inflation that year. Let's look at an example. For the sake of using a nice round number, let's assume you start retirement with a $1 million portfolio. In year one, you'd be able to withdraw $40,000. To determine that amount, simply take your $1 million portfolio and multiply it by 4%, or 0.04. Then, let's assume there's 2% inflation in that first year. That inflation amount will determine your second year's withdrawal. In year two, your total withdrawal would be $40,800. This amount was calculated by taking your previous year's withdrawal of $40,000 and multiplying it by 1.02, which is simply adding the previous year's 2% inflation. And then assume the amount of inflation in the second year is 2.3%. That will be used to determine your third year's withdrawal. So then in year three, your total withdrawal will be $41,738, which is the previous year's withdrawal of $40,800 multiplied by 1.023, which is just adding year two's 2.3% inflation. And then in the third year, assume there's 1.5% inflation. You would continue on with this inflation adjusting withdrawal calculation process during each year of retirement. Now, it's important to know there are a lot of assumptions that go into the 4% rule. And for better or worse, you need to play by its rules for it to work, as Bengen's research proved it should. Here's the main assumptions behind it. First, you can withdraw no more than the prescribed amount. It's called the 4% rule, not the 5 or 6% rule, which means you can't withdraw 5 or 6% every year. You can, but you'll obviously increase the chances of depleting your portfolio during retirement. Next, it assumes your withdrawals are only needed for about 30 years. Specifically, in Bengen's research using 75 years of actual data, there was no scenario or span of history where a portfolio ran out faster than 33 years. Therefore, according to the rule, if you're only withdrawing for about 30 years, you should be okay. But if you retire at 50 and need to live off your savings for potentially 40 or more years, withdrawing 4% may not work. This next assumption is increasingly called into question. The 4% rule assumes future rates of inflation and returns for stock and bonds will be like those of the past. Some experts feel we're bound to see high inflation at some point, especially considering how much money is getting printed as a result of the coronavirus pandemic economic stimulus initiatives. Also, interest rates on bonds are currently at historic lows. That means the amount of interest income generated by bonds is lower now than it has been throughout most of history. All else equal, that means bonds should be expected to perform worse than they have in the past. Put it all together, and many industry experts feel the 4% rule should be revised to something like the 3% rule to account for possible higher inflation and/or lower investment returns going forward. The other big assumption is that your portfolio is invested in diversified holdings of approximately 60% stocks and 40% bonds. I believe Bengen's data used ranges from 50 to 75% stocks and therefore 50 to 25% bonds. These ranges aren't necessarily problematic, as the typical retiree mix is about 60% stocks and 40% bonds. But if your particular stock to bond allocation is outside of the ranges Bengen used, all bets are off with the 4% rule. Also, Bengen's data assumes just US stocks and US bonds were used. Historically speaking, if you had sizable portions of non-US assets in your portfolio, the 4% rule wouldn't have held up quite as well. I ran my own historical test of the 4% rule for the 30-year period starting in 1990 and ending in 2019 to see how it would have held up. I used a starting portfolio value of $1 million. I assumed the portfolio was invested 60% in the S&P 500, which is an index that tracks the returns of the 500 largest companies whose shares are traded on US exchanges. I assumed the other 40% was invested in the Bloomberg Barclays US Aggregate Bond Index, which measures the US taxable bond market, including government bonds and investment-grade corporate bonds. And at the beginning of each year, the portfolio was assumed to be rebalanced so that it started the year at exactly 60% stocks and 40% bonds. And then whatever the return was of that 60-40 portfolio, I deducted 1% each year to account for the fees investors would have likely experienced in investing in funds that actually gave them exposure to the indices. Because you can't directly invest in an index. You can only invest in a product that tries to mimic an index, and the product is going to have some kind of fees associated with it. Here's how things would have looked over the last 30 years. The right axis and the blue bars show the total annual withdrawals each year. The first year's withdrawal was $40,000, which was 4% of the $1 million portfolio starting value. And then the withdrawals went up a bit each year by the amount of inflation as measured by the Consumer Price Index. In the 30th year, the annual withdrawal would have been nearly $81,000. The left axis and the orange line shows the portfolio value at the end of each year. You can see it started at $1 million, and over 30 years, it actually grew to just about $3.7 million, even after accounting for the annual withdrawals. As you can see, the 4% rule held up phenomenally well during the last 30 years. In hindsight, a 4% withdrawal was overly conservative in this case, as the portfolio ended up nearly quadrupling over time. Clearly more money could have been taken out along the way. However, the results can be drastically different depending how the markets perform in the first few years of your withdrawal period. This is due to something called sequence of return risk. At a high level, sequence of return risk says that if you have a few bad years of investment returns in your first few years of withdrawals, your portfolio won't last as long as if you instead had a few strong years at the beginning. Even if the average return over 30 years ends up being the same in either case, the timing or sequence of returns matters. If you want to learn more about sequence of return risk, check out my other video, What is Sequence of Return Risk? Let's go back and look at how the first 10 years looked from 1990 to 1999. During that time, there were monstrously good returns in the US stock market, largely driven by the boom in technology stocks. So even though you were taking money out each year, the portfolio gains more than made up for it. After the first 10 years, your $1 million portfolio would have been about $2.4 million. Let's contrast that to what would have happened if you instead started withdrawing 10 years later in 2000 instead of 1990. Due to the bursting of the tech stock bubble and the events of September 11th, the US stock market had losses in 2000, 2001, and 2002. As you can see, those losses and your annual withdrawals would have really eaten into your portfolio in the early years. After just the first 3 years, your $1 million portfolio would have decreased to about $730. And then the markets came back and stabilized some, but then the global financial crisis hit, and 2008 was a horrible year for the stock market. By the end of 2008, your portfolio would have decreased to almost $600,000. And then in the 11 years after that, it would have stayed about flat, ending 2019 at around $600,000. All said and done, if you started withdrawing under the 4% rule in 2000, your portfolio would have dropped about 40% after 20 years. That's in stark contrast to if you started 10 years earlier in 1990. If you started then, after 20 years, your portfolio would have been up over 200%. Clearly, sequence of return risk matters. But still, according to Bengen's research using historical data, including periods like the Great Depression, the 4% rule would have held up for no less than 33 years. Is the 4% rule a good tool? I feel it is, but it's just a rule of thumb, one that uses lots of assumptions. Therefore, it's far from bulletproof and shouldn't be the end-all be-all of your retirement planning. It's a really good estimation tool that can let you ballpark how much money you can safely withdraw in each year of retirement. And it can be used in reverse too. In other words, instead of just telling you how much you can withdraw from a given portfolio, you can tweak it to tell you how much money you need saved to support a given level of withdrawal. Working backward, for example, if you know you wanted to withdraw $50,000 in your first year of retirement, you can simply divide that by 4% or 0.04 to back into how much portfolio you would need. In that case, you need a portfolio of about $1.25 million. That's it. That's the 4% rule. I hope you found this video helpful. If you haven't already, subscribe to this channel so you can be the first to know when new videos are posted. And don't forget to subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. Also, be sure to join my free Facebook group, Taxes and Retirement, where you can get answers to all your retirement-related tax questions. Thanks for watching. I'll see you soon.